Hi everyone, and welcome to today's market update. I am here to give you a quick rundown of what's happening in the financial markets right now, what's moving war to watch, and what it could all mean for you. Let's dive straight in. First up, let's take a look at the global markets. In the United States, the major indexes have seen some significant movement over the past week. Investors are trying to digest a real mix of economic data and some pretty big company earnings announcements. The Dow Jones Industrial Average, the S&P 500, and the tech-heavy Nasdaq Composite have all been reacting to a flurry of corporate results, which have been a mixed bag, to say the least. On top of that, everyone is trying to guess what the Federal Reserve will do next with interest rates, and we're seeing some interesting shifts in which sectors are leading and which are lagging. It's not just a US story though. Over in Asia and Europe, markets are just as sensitive to what's going on. They're keeping a close eye on ongoing trade talks, currency fluctuations, and what their own central banks are signaling. If there's one strong theme emerging right now, it's that the global economic picture remains pretty uncertain. There are definitely risks on the horizon, but there are also some clear opportunities popping up. So, to put it simply, risk assets like stocks are experiencing some volatility, and investors are really searching for clarity and a clear direction. Everyone seems to be holding their breath just a little, waiting for the next big signal. So, what's actually driving all this movement? Let's break down three of the biggest factors at play right now. First, and arguably the most important, are corporate earnings and their outlooks for the future. We've had several large, influential companies report their quarterly results, and it's been a real mix of beats and misses. What's really interesting is the ripple effect. When a major player, a bellwether for its industry, reports weak guidance for the coming months, that tends to drag down the entire sector with it. We saw a perfect example of this recently, where one earnings miss in the semiconductor space weighed heavily across the entire tech industry. On the flip side, when a company surprises with unexpectedly strong results, it can lift sentiment across the board and get investors excited again. The second major driver is, of course, interest rates and monetary policy. The expectation of what the Federal Reserve will or won't do is front and center in every investor's mind. Will rates go up to fight inflation? Will they stay the same to see how the economy holds up? Or will they start to come down to stimulate growth? Each possibility has huge implications for stocks, bonds, and pretty much every other asset class. The will they or won't they drama around the Fed's decisions is creating a lot of the day-to-day choppiness we're seeing in the markets. And the third key driver is geopolitics and trade. Ongoing trade negotiations, the threat of new tariffs, and disruptions to global supply chains continue to be a major influence. These aren't just abstract headlines, they have real-world impacts on company costs and international sales. For instance, one recent positive development was a bit of perceived progress in US-China trade discussions. And that immediately helped spark some optimism and gave the market a temporary lift. Any news, good or bad, on this front can swing market sentiment in a heartbeat. Now, let's zoom in a little and look at some specific sectors and asset classes that have been making headlines. The technology sector, particularly anything related to AI and semiconductors, remains a huge area of focus. You have some companies that are investing billions into artificial intelligence, and investors are watching these moves very, very closely, trying to pick the long-term winners. At the same time, this sector is vulnerable. As I mentioned earlier, some weak guidance from a key chip maker recently hurt the entire semiconductor group, showing just how interconnected these companies are. It's a classic high-risk, higher-reward scenario playing out in real time. Next, let's talk about energy and commodities. With global inflation still a concern and ongoing geopolitical tensions, energy and commodity-related assets are giving off some mixed signals. On one hand, you have some potential upside due to supply concerns, which can drive prices higher. But on the other hand, there are persistent worries about slowing global demand, which could pull prices back down. It's a real tug-of-war between supply and demand fears right now. What about bonds and yields? They tell a fascinating story. Interest rate expectations are directly affecting bond yields. When yields rise, it tends to put pressure on growth stocks, especially in the tech sector, because it makes their future earnings less valuable today. Conversely, when yields fall, it can give those same growth stocks a nice boost. So, keeping an eye on the bond market is a great way to get a sense of where the smart money thinks the economy is headed. Finally, currencies and safe havens. When risk sentiment weakens and fear starts to creep into the market, investors often flock to so-called safe havens. These are assets like gold or certain currencies, such as the US dollar or the Swiss franc. The uncertain global backdrop means these dynamics are more important than ever. For example, recent market dips have been tied to fears of a broader economic slowdown, and during those times, we saw a clear move into these safer assets. So, with all that in mind, what should we be watching for next? What are the key upcoming events that could move the markets? First, keep a close eye on the upcoming earnings releases from major companies. We have another wave of reports just around the corner. Investors will be dissecting not just the headline revenue and profit numbers, but more importantly, the forward-looking guidance and the company's plans for capital spending. That guidance is what really tells you how confident a company's management is about the future. Second, all eyes will be on the Federal Reserve and other central banks, along with the economic data they watch. Key reports on inflation, employment, and consumer spending will be crucial. A surprisingly high inflation number or a weak jobs report could easily force the Fed's hand and send ripples through the entire market. Third, of course, is any development in trade negotiations or geopolitics. Any major breakthrough or, conversely, a sudden escalation in tensions can influence market sentiment almost instantly. These are the wild cards that can override all the other data points. And finally, it's important to watch the market's technical levels and overall sentiment. Sometimes, even if the fundamental data is steady, markets can move simply because sentiment switches from fear to greed, or vice versa. Certain price levels on charts can act as psychological barriers or support. So it's always wise to keep an eye on the economic calendar, but also to stay flexible and be aware of how the mood of the market is shifting. To wrap it all up, the markets are in a fascinating phase where both significant risk and real opportunity exist. On one hand, a string of strong earnings reports or positive signals from policymakers could certainly drive stocks higher. On the other hand, weak corporate guidance, unexpected policy surprises, or geopolitical shocks could easily trigger a pullback. If you're invested or thinking about investing, this is a time to stay informed. It's a good idea to ensure your portfolio is diversified, to have a clear strategy for managing risk, and to try to focus on your long-term goals, even while you pay attention to all of these near-term events. Thanks so much for joining me for this update today. If you found this helpful, please do me a favor and hit that like button, and be sure to subscribe for more content like this. And if you have any questions, please leave them in the comments below. I'll do my best to answer them in the next update. Until next time, stay alert, stay balanced, and I'll see you in the next video.